I don't feel like investing. That's okay. We don't invest on feelings. For all of our talk about being sophisticated and logical investors, for many of us, we primarily make investing decisions based on how we feel. And there can be vast differences in how we feel about investing, and a lot of that comes down to how have our investments done? What is the market doing right now? How has it been doing lately? And with what is, especially recently, what has happened can often dictate what we do. And as much as we can talk about being logical and history and all these things, we so often can invest based on our feelings. And so there's two examples, I think, that dictate how we invest based on feelings. And one is we invest based on euphoric feelings. Right? We love investing when the market is raging, when it's just going up and up and up and our money is just compounding over time. And we're like, wow, this is really fun. And when the values of the best businesses in the world are surging due to growth in the underlying values of the companies themselves and their assets and their patents and all these things, and based on the increasing demand as more and more people join in the market, join in the euphoria, join in the fun, we see those shares surging in price, growing, and it's fun, and we love to invest, and it's euphoric, right? Surely what has happened recently will continue to happen ad nauseum. We saw this in 2019, right after a 10-year bull market, after the values of the best companies in the world were going up for 10 years almost in a row. And we saw it again in 2021 after the COVID crash. And with the COVID stimulus buoying the values beyond what was ended up being reasonable in that short amount of time. And everyone loves to invest when the markets are up, right? A lot of people got into the markets in 2019 when they were been going up for a while, and got into the markets in 2021 after it had been going up for a while. And it's a fun time to invest. It's euphoria, right? Another time that the market dictates when we will invest based on our feelings is investing based on depressed feelings, right? We hate to invest when the markets are volatile, especially when that volatility is in the downward direction. Right? Volatility, in definition, means up and down, and no one ever complains about the up part of volatility. It's the down part we don't like. And so it makes us nervous, right? And I don't want to lose money, we think. We saw this in 2020 with the COVID crash, right? And in 2022 and 2023 with the inflation and interest dip that we've been getting through, and people get skittish. Right? And some people commit the gravest of sins, right? They sell their investments while the values are temporarily low, right? Turning a temporary decline into a permanent loss. They're killed by that fourth horseman, right? Panic. We've talked about that a lot. And while others may never sell, right? They don't commit that most egregious of crimes. They don't invest either. They have new money that they could invest, but they don't want to because they don't feel good about the market. They don't feel like investing. Of course, we know there's great power in investing, in becoming co-owners of the best businesses in the world. As a quick review, right? The results. If you had invested $10,000 in 1993 through November of 2023, about 30 years there, the U.S. stock market, and you invested in the U.S. stock market and $10,000 in the U.S. bond market and $10,000 in cash, what would the results be over that time? Right. Well, investing $10,000 in cash over those 30 years would result in about $20,000 today. So it would have doubled in 30 years, right? Just in cash money market type accounts, right? Not literal cash and bills. That would obviously just sit there. But if you had it in cash accounts, interest bearing savings accounts, etc., 2.36% over those 30 years. Go from 10,000 to 20,000. If you had invested it in bonds, which is the total U.S. bond market over that time, that got an average of 4.3% over those 30 years, and you would have about 36,700. So from 10,000 to 36,000, tripled and then some your money over those 30 years. But if you invested in just the U.S. stock market and left it there for 30 years, your $10,000 would have turned into $179,000. Or an average of 9.79% per year, right? In that 10% that we're always talking about, right? Because left to itself over long periods of time, we know that being co-owners of the best business in the world generates on average 10% per year, which over 30 years does quite a bit, nearly 5 times more than you would have gotten in bonds. And remember that during this period, right, during these 30 years, the value of the S&P 500 halved twice. Literally 2 times. The values got cut in half, and you're still up 17 times, almost 18 times what you would have had 30 years ago. Add to that multiple wars, a global financial crisis, a global pandemic, and with all that, still 5 times more than you would have invested in bonds. You got 5 times more being owners of companies, investing in ownership, than investing in debts. Let me ask you this, right? Which is more likely? If we know, even if we don't always feel it, if we know that the values of the best business in the world, aka the stock market, if we know that those go up and down all the time, more up than down, and we know, even if we don't always feel it, that over the long term, right, investing and owning these companies produces the best long-term results. And if we know that only, we don't not only go through the bad periods, but we also have good periods, right? And to get those good periods, we need to be in the bad periods. If we know all these things, we'll have these periods where the values temporarily decline, aka bear markets, right? Then when is the next bear market likely to occur? Okay, if we knew all these things, we know the volatility, we know the general trends, when is the next bear market likely to occur? Either A, after the market's been going up for 10 years in a row, or B, immediately after one we just had. What's more likely? Right? And of course we know that, no one knows, but I think all of us would guess, hey, you're more likely to see a down market right after a really long, really good market. Right? So if the market had been going up from 2009 to 2019, you had 10 years of almost straight growth, what's more likely, a bear market at the end of that, or a bear market now after a COVID crash, after the 2022-2023 dip? What's more likely? Again, no one knows when the next one's going to be. But it's at these times when the market doesn't feel as good, right? When you've had a lot of volatility over the last few years, when we're still, as I'm recording this, not back yet to the all-time highs at the end of 2021, it doesn't feel good to invest. And I've had conversations with clients where they have money to invest. They didn't pull out. I would never let any one of my clients make that mistake, but they have other money and they don't feel like investing it in the stock market, in equities, because they're uneasy about what it would do. But really, this is probably the best time. Not the best time. The best time to invest was when it was at the bottom, of course. But this is a much better time to be invested than at the top of a long bull market. So what is more likely, right? Because to me, I think the best times to invest are after all that stuff's gone. When everyone else is worried about the market, that is the best time to invest. And when everyone's excited and euphoric about the market, that may be the worst time to invest. Or as Warren Buffett so succinctly put it, right? Be fearful when others are greedy and greedy when others are fearful. So when should you invest? When you feel like it? No. You may ask, is now a good time to invest? And let me answer that with a different question. What's the best time to plant a tree? 30 years ago. What's the second best time to plant a tree? Today. And I think the same thing could be said about investing. The best time to invest in the US stock market and the best businesses in the world would have been 30 years ago when you could have turned $10,000 into $179,000. That would have been the best time. The second best time is today, when you have the money. The best time to invest is when you have the money. And after 2020 and 2022, it sure feels, right, that we are due for another strong market, that maybe the worst is behind us. And I sure would hate to be on the sidelines when the next 100% increase happens. But we don't invest based on feelings. We invest when we have the money and we're not going to need it anytime soon. And we invest and become co-owners of more of the best businesses in the world. So don't invest based on feelings. Have a plan, stick to the plan. If you need help doing any of those things, investing not based on feelings but on a plan, that is what we do. We'd love to talk more with you about it. Have a great week. We'll see you next week. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.